What's up, everyone? Welcome to a special live stream of the Fed announcement. See what happens, see what moves happen. But yeah, it's going to be kind of chilling. I told everybody before stream I didn't trust this up move that gold was having. So you can see it drop down. What I'm honestly expecting, big move down, go up like that. So we'll see how that turns out. What's up, throwbacks? Thanks for tuning in again. Always on the streams. That's sick. Good job. I'm going to pull up Forex Factory in a second here. Probably going to be like a 45-minute stream. Got the federal funds rate at 12 and then the FOMC press conference at 12:30. So still watching game, waiting game right now. Some nice moves. Euro tanked so hard after. We got this short here, and then we called another one right here. But wow, it hit all the way to like 118.10. That was a crazy trade. Honestly, looking at yesterday's move, I was analyzing yesterday's move too. Look at that trend line. When this trend line and this support was broken, wow, that dropped huge. Even if you get like here to here, it's about 20 pips. But yeah, as you can see, it dropped even further than that. So it's good to always analyze, keep looking at your trades, seeing what happened, what went right, what went wrong. Also, if anyone's trading, don't have a position open during news. Wait 6 minutes, see the direction. Trade based off of that. I'm not trading. I've gotten killed on Fed news before. So I honestly just gotta wait a little bit. Yeah, no, that's a good idea. Just learn for the session, even watch it, right? From now till 12:30. Well, 5 minutes still, and then until 12:30, you're gonna see a lot of volatile movements and fake outs. I'm gonna be pretty patient with it. Like I said, I think it's gonna have a big wick down, maybe the 50s area, and then go up like that, just based off higher time frame structure. You can see that this is a green candlestick. I mean, if this rejects too and goes bearish, you got a lot of room towards the downside, right? So let me be preparing for both sides. We'll see how it opens when news hits. But yeah, you can see it was choppy for most. So Yeah, I think it'll be like a more informational learning session today. So just gotta wait and see what happens with these moves. One second, I gotta set out a few emails really quick. Two more minutes until the news happens. Hope no one has the trade open. Well, I don't know whoever's tuning in. Interesting. One more minute. We'll see what happens. Behind. 25 seconds should be interesting. We'll look at Euro USD too. See what happens there. Remember, don't trust any move right now. It's faking everybody out. So we'll see what happens. 1 second. Boom. Nothing. What a dud. Nah, I'm playing. Something should happen. Wow. They definitely don't chase anything right now at all. You might even see this go all the way down. So see if it. No, they made it stay the same. But the real thing is gonna be what Jay Powell says, right? So whatever he says is gonna go down. I knew that long was bullshit. Seen this shit time and time again. Honestly, wait like 10-15 minutes, you'll get true direction. And when it breaks this area up here, that's an easy 100 pip long when that happens. So we'll keep an eye out on that too. But right now, I think we just gotta wait a little bit longer. Like that fake out. At least wait for the 5-minute candlestick to close or something. I am more inclined to go on the long side too. So if it gives me another chance to enter on the long, I might. This is why you don't trade news though. Look at this. 80 pip 1-minute candle. That's insane. $8 1-minute candle. Let's just check this out. Might as well. Federal Reserve Board statement. Yeah, I think we wait though. This 5 minute should close in a bit here. And with that close, might enter a small position, but we'll see. It's always tough trading news because no one really knows, right? You can only play the price action. You're not an insider. No one knows what's happening. And in reality, you're just gambling your money if you're trading news. Right? It's better to be safe, preserve your capital, wait for structure formation to form, and then go with the direction after. This is why you don't chase the long. Chase the long, you're down what, 60 pips by now? Wow. I'm tempted to enter a small position. I actually am tempted to enter a small long. Do have profits to risk from earlier, so you know what? Entered a small long, 63. Literally just punched in at 63. I'm gonna have a pretty decent stop. I'm in a quarter position size, so that's literally like nothing. Wait, is it even quarter? No, 1/6. Because you never really know. Like, yeah, this thing closes. I'm gonna hold it. This might be my like longer term trade. This thing might close bullish right here, but next one you might get like a wick. It'll just be like indecisive. So, sheesh, gems, sensei. Thanks, man. Thank you. No, it's just experience. Like, I'm not the most experienced or the most knowledgeable person. I'm still improving. Still a lot to learn, but like, you know when it's faking out or when it's about to do stuff like this, right? I'm in a very small position. That's why I'm pretty relaxed. Like, I don't really care if I take a loss on this trade. Fuck it. I had some profits from earlier. Could risk on it. This is why. Look at that. Another one like that. The indecisiveness on this trade is actually crazy right now. Might actually, give us a little bit more room since I'm only in a quarter position. Might as well let it ride a little bit. Now I can have another entry somewhere down here. And probably should have had another entry. It's all good though. So I just got another quarter entry. Now my average is so I'm at 60. Yeah, my average is around 61.80. And this is on a third of a position. Stop loss is gonna be below here. Oh, there it goes. This is why you can't risk too much on this trade. Look at that movement. Boom, boom. And this, honestly, I could see this push all the way up now. But obviously, we'll have to wait and see. That's why you have to give it some room to move. 56. Let's go 55. I feel like if it hits 55, it'll go lower. So 61. I'm risking 60 pips on the trade. Ain't too bad. On a third of a position. Yeah, that's pretty good. And to be honest, starts breaking this area up here, might enter on an average up, but that's a big if, right? Obviously, you want those better entries somewhere down here, but sometimes you can't always get those, you know what I'm saying? Sometimes you gotta get whatever's available to you. And at this point, might be based off the 1 minute if this starts reversing. And yeah, the short side's still in play too, don't get me wrong, but the short side has to break a lot of levels. This level, and then eventually this level for the short side. I'm just basing it off my longer term analysis right now. So we'll see. Especially if this candlestick starts flipping bearish, yeah, that's going to be a nice short sell for sure. So as of right now, I'm just playing it. Got some profits to risk from earlier, so I'm not too concerned at all. I'm pretty chill on this position right now. Thanks, man. I'm trying to kill it, but it's still tough. It's news, you know. My risk is reduced considerably right now. Yeah, even based off this 1 hour, it doesn't look so fly. Yeah, even this one. Biggest thing is that I had to break this upper level at like 171, 171, 1971, 1972. So if it broke above there, especially like 1973, 1974, that's an easy long. Now you're like in this kind of mini wedge from that big wedge we had. So yeah, that big wedge over here, it broke that, multiple tops, still creating like higher lows and higher highs. So we'll just have to wait and see how it turns out. Because now we look at 15 and 30. We're at this support area too on the lower time frame. We'll see. I'm gonna have to delete these drawings, go back to this chart. Pretty generous stop. This is where my bias might be against me. You never know, right? Here's another 5-minute candlestick finished red. So when it goes to a new zone, kind of when it's at a zone, there's a lot of indecision. There's a lot of conflict between the bulls and the bears. Like up here, there's no real direction. Right here, it's given it somewhat of a direction right now. So yeah, no, it's not really new range or anything. It's just given conflict between bulls and bears. Hit my stop loss? Yeah, I hit my stop loss down here. Well, I'm out of that trade. That was a fail. That was fun though. Risked only what, like 10% of my profits from earlier. Think I gotta wait. If I am bullish on it, if it is truly a bullish move, then it should create bullish structure on the lower time frames before going up. And in reality, it's still at this support I'm looking at. So if it finishes below that, yeah, I'll enter a short. But if it stays above here, if it kind of goes down a bit, then something like that, I'll definitely take a long position. 1 second. We'll see how the markets react. The markets went up too. Where's QQQ? Yeah, markets didn't do much. Dollar index way too indecisive too right now. So Boom. See that? Look at that rejection. That's what I'm talking about. That's exactly what I think it would have done. So it's got another. I got quarter this time. So I got a quarter instead of a sixth. Same stop. Stops below here. 54.80. But we'll see how this one goes. I'm not going to add. Whatever happens, happens. This is fun though. Yeah, see that fake out? This is probably going to create a new high. Could honestly see that happening. Look at that. Big liquidity grab. Yeah, that's pushing up higher. Let's go. Two more minutes till 15-minute closes. And look at that 15-minute. That is crazy. There we go. That's much better. Got what, 30 seconds before the minute closes? If the next 15-minute kind of has like a pullback, probably get one more position. We'll see. Or to be safe, I might just buy above the highs. $15-minute close. Closed bullish. Your 5-minute opening up. It's about to blast through. So I have a buy stop at 65, and right now my entry's at 59. So my average would be, what is that? 65, 59, 30 pips, 62 would be my average if it gets hit. Move that up. And that would be a half position size right there. So, did it get hit yet? No, I never got hit yet. So we'll wait. Right now I just have 59. But I have a buy stop at 65. If that gets hit, then we're good. Shit, sorry. I'm eating my lunch, dude. No, anyone realize? I'm gonna move this down until my buy stop gets hit. I'm at 59 right now. 59.50. I mean, 30-minute looks good. Doji to this one. If this finishes strong bullish on the 30, then we're good. Then we can see a break above here. If it breaks above here, then I might get like another quarter to push up. So we'll see. I feel like 2000 will get hit. Where we at? Yeah, 2000 area right here. I feel like that's a good target. Maybe into tomorrow or something. We'll see stops at break even, and then yeah, we'll go from there. Honestly, based off this daily structure right now too, this finishes bullish above these candlesticks right here, above this zone. We're going up. We're going to 2,000. Might have to look for more entries. At least the wick fill, 1990, and then up to 2,000. Even on the weekly too. Yeah, weekly still up here, but I feel like we're gonna finish bullish. Yeah, there it goes. Got hit. Now I can move this up. Should play out if it doesn't break even. Ain't losing, ain't winning, but fuck it, right? So honestly, I don't think I'll add more positions till Asian session. Even if it breaks above the highs, fuck it. Can always then have opportunities to enter tomorrow. Maybe I'll pull back during Asian session. You never know. I'll be right back. That retraced decently. Let's see. Nah, it's still good. My average price is still good. Nothing to really worry about at the moment. So, oops. Kind of slow. I'm gonna see if I can pull up a live stream of Jay Powell to watch him too. Live stream on a live stream, straight Inception style. Let's go. Yeah, you see 5 minute break now. I was looking. I was getting my coffee. No, this one. This one. I drew it out in the morning too. Finishes. Body goes above here. You're good. Daily candle finishes bullish. First area might be here, but I do feel like we're gonna hit like 2,000 maybe up here tomorrow or by Friday. So we'll see. We'll hold it for now. Um, see how the price action reacts. Yeah, even this one too. I kind of drew it. It's not as similar, but gonna see that bullish move up if it is in fact a true bullish move. Five more minutes. What's a 5 minute candle? Well, 4 more minutes now. Perfect. Here's the live stream. Pull up. I'm gonna turn off my music for now. So we'll just have to wait on that. It's gonna be a patience game. 4 more minutes here. Throwbacks. He's still there. He's chilling. Work pickup or something. It's quite slow. We got 2 more minutes till Powell comes on, and then that'll be interesting. You might see some volatile moves when Powell comes on. Then your 30-minute opens it might go like that, and then like that, or even like that, and then like that. So it's gotta watch, play the price action, see what everyone or the herd is doing. In this case, the herd might be right, or the herd mentality in this sense. Oh damn, here he is. Nice.
Committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability.
I got Black Bull on my other screen, so we'll just watch this. If anything happens, I'll pull up the chart.
To provide some
You can also see the price up here.
be as strong as possible and to limit lasting damage to the economy. Today, my colleagues on the Federal Open Market Committee and I made some important changes to our policy statement, including an update to our guidance for the likely path of our policy interest rate. Guided by our new statement on longer-run goals and monetary policy strategy that we announced a few weeks ago, these changes clarify our strong commitment over a longer time horizon. Before describing today's policy actions, let me briefly review recent economic developments. Economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interactions, household spending looks to have recovered about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Activity in the housing sector has returned to its level at the beginning of the year, and we are starting to see signs of an improvement in business investment. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, roughly half of the 22 million jobs that were lost in March and April have been regained as many people return to work. The unemployment rate declined over the past 4 months, but remains elevated at 8.4% as of August.
Excuse me.
Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 7.6% at the end of this year, 5.5% next year, and 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. For some goods, including food, supply constraints have led to notably higher prices, adding to the burden for those struggling with lost income. More broadly, however, weaker demand, especially in sectors that have been most affected by the pandemic, has held down consumer prices. And overall, inflation is running well below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.7% next year and reaches 2% in 2023. As the economy began its recovery, COVID-19 cases, hospitalizations, and deaths also rose. The reimposition of some social distancing restrictions, as well as more cautious behavior by many individuals, have succeeded in slowing the spread of the virus. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on our success in keeping the virus in check. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. The path forward will also depend on the policy actions taken across all parts of the government to provide relief and to support the recovery for as long as needed. The Federal Reserve's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We remain committed to using our full range of tools to support the economy in this challenging time.
That means they could print money at any time.
We may, in today's policy statement, reflect our strategy to achieve our dual mandate goals by seeking to eliminate shortfalls from maximum employment and achieve inflation that averages 2% over time, as we articulated in our statement on longer-run goals and monetary policy strategy. We view maximum employment as a broad-based and inclusive goal and did not see a high level of employment as posing a policy concern unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. And we believe that achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at our longer-run 2% objective. In turn, well-anchored inflation expectations enhance our ability to meet both our employment and inflation objectives, particularly in the new normal, in which interest rates are closer to their effective lower bound, even in good times. Hence, as we say in our statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take. Of course, as we note in our policy statement, we would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating the damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department, and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and appear to have restored the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. As I've emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support is needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Finally, I would like to take a moment to recognize the passing of our friend and colleague, Thomas Laubach. His outstanding analysis and advice have been indispensable to the FOMC and have played a key role in the policy decisions that will define this era of the Federal Reserve. He will be remembered for his intellect, but also his kindness, his equanimity, and his dedication to achieving our mission on behalf of the American people. We will miss him. Thank you. I'll now be glad to take your questions.
Thank you. Nick Timrose.
Good afternoon, Chair Powell. Timrose from the Wall Street Journal. You've been very clear about the committee's intentions on rates, not even thinking about raising rates, and today showing low rates even as unemployment falls to 4% and inflation rises to 2%. My question is about asset purchases. Does the guidance today apply to the current asset purchase pace? Are there any macroeconomic conditions under which you would favor increasing the monthly pace of Treasury and MBS purchases? And under what conditions would a decrease in the monthly pace of purchases?
So let me explain what he said. He basically said the unlimited tools that they have at their disposal, that basically means they have a fancy red button to print a lot of money, keeping inflation at a target of 2%, to kind of erodes the value of the money, but steady growth might be beneficial long term. He also said the economy won't be up to where it was at the start of the year, but it's slowly recovering. It's kind of an uncertain and bleak outlook on the economy right now because no one really knows how the virus is going to react in the winter months coming up or what's going to happen with the election. So there's a lot of uncertainty with the economy. With all that combined, should see this push up. And if this pushes past 1972, 1973, like if it's 1973, putting this to like break even, maybe even like 64 for some profits and just holding it for the rest of the week, maybe. Shit, I don't know. We'll see how that goes. But yeah, no, I got up on my black bull. It was a crazy down move to start. Then up, even euro too. I had euro and I was like, God damn, mid new low, and it pushed all the way up. So there's a lot of buying on it. See what Powell says now.
Tool when the Fed has talked about those two policy tools working together.
So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today, we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery. And that should be a very powerful statement in supporting economic activity. Now we're buying 120 billion in securities per month across the Treasury curve. That's also adding to accommodation. We do have the flexibility to adjust that tool and the rate tool and other tools as well. But as for right now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
Thank you.
Hi, Cheryl. Your question, Jean with New York Times. I was wondering if you beefed up your language on financial stability in the long-run statement that you unveiled with your Jackson Hole speech last month. I'm wondering if you could kind of walk us through how you think about financial stability concerns as a factor in guiding future Fed increases. Would financial stability concerns on their own be enough to merit changes in the Fed funds rate? Or would they have to come in conjunction with an overheating on inflation or some sort of dramatic drop in the unemployment rate? If you could just sort of give us an outline of your thinking there, please.
So what we said in our statement on longer run goals and monetary policy strategy was that the committee's policy decisions reflect its longer run goals, its medium term outlook, and its assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So that's what we said about financial stability.
I think I'm going to end it soon here. Let me turn on my music again. Yeah, I mean, this is why it's tough to trade the news. Don't really know what the hell is going to happen. And as you can see here, it went all the way up, went all the way down, up and down, which is crazy. So look on the 1 minute, you can see all this volatility happening. Really a lot of indecision, indirection, misdirection, etc. So, in hindsight, it might be better to stay away from the news. I still have a feeling if it breaks above here, it's going to head up higher. It might do that in the next hour. I mean, we still got 15 minutes for this hour. And depending how this hour candlestick finishes, I think that'll be the true direction we get. So we'll see how it heads into 1 o'clock. Hope everyone stayed safe during this trade. I still have it. It's only a half position. I'm not really risking a lot except some profits from earlier. Other than that, hope everyone has a great day.